ACCA students, welcome back to ACCA MOXIE. I'm gonna start the capital structure chapter. In this chapter, we will understand how the capital how the capital of a company should be structured in a way that it reduce the WACC. It means it is all reduce the cost of capital for the company. Okay, so first we will understand some of the terms like operating gearing, financial gearing, and the impact on the WACC. Then we will understand some theoretical aspects like traditional view, M&M tax, no tax, pecking order theory. Okay, so let's understand this operating gearing. Operating gearing is a measure to the extent to which a firm operating costs are fixed. It means it is a measure. It is a measure. It is a measure which means that it measure how much is the extent, how much is the fixed cost, how much is the fixed cost out of total cost. So how much is the fixed cost out of total cost? Okay, so another formula for this is you can use this as well, fixed cost divided by the variable. Okay, so greater the operating gearing, which means that greater the EBIT variability and lead to business risk. So if you have the high fixed cost, which means you face the business risk. So if you have the high fixed cost, which means that your EBIT, earning before interest and tax, will reduce. Okay, your EBIT will reduce and your business risk will increase. Okay, but if you have the lower fixed cost, your EBIT will increase, your earning before tax will increase, you have more income. Okay, and your business risk will reduce because you don't have the fixed obligation on the business. Okay, that's why your business risk is reduced. So let's understand this through a question. So this is the question and this is the solution. Okay, so two companies have the following cost structure. Okay, so the firm A and firm B. What is the level of operating gearing? We have to calculate the level of operating gearing in each. What would be the impact? What would be the impact on each? What would the impact on each if 10% increase in sales? Okay, what is the impact if 10% increase in sales? 10%, and if this is 10% increase. Okay, so if we have the fixed cost, that is here it is only $1 million, and here we have the $3 million. So what will be the impact on EBIT? Let's calculate, but currently it's the same for both the business, but let's see how this impact if we increase this by the 10%. Okay, so operating gearing, firm A and firm B, fixed cost divided by variable cost. Okay, we are using this formula for here. Okay, so 1 divided by 1 is the fixed cost here for firm A, and the variable cost is 3. Okay, so 1 divided 3, 0.33, and here you have the 3 and divided by 1. 3 divided by 1, you have the operating gearing as 3 times. Okay, here you have only 0.33 times, here you have 3 times then your fixed cost. You have the fixed cost 0.33 times of variable cost. Here you have 3 times of variable cost. Okay, so it's a operating earning will therefore be more volume sensitive. Okay, so if you increase this by 10%, so this is the, and you have to increase variable cost, because when you increase the sales, your variable cost will increase as well. You know this already. Okay, so this will increase as well. So your fixed cost for firm A is 1 and for this is 3. So the fixed cost is 1 and 3. Here it will remain the same. Here it will remain the same. Okay, so then you have the EBIT. EBIT here is the 1, 1.2 that changed to 1.2, and here you both have the 1, 1. Then here it's changed to 1.4. So when we calculate the increase in EBIT, so when we calculate the EBIT increase, this is the 20% increase. This is the 20% increase. But here it's 40% increase. 40% increase. Why it is 40% increase? Because you have the fixed cost. You have the fixed cost that has not increased, that has not increased in proportion to your increase in sales. So when you have the fixed cost, it is beneficial for us sometime, but it is not beneficial for us it is beneficial for us when it is increase in sales. In increase in sales, it will lead to increase in profit, EBIT. But when it is decreasing the sales, when the sales will decrease, when the sales decrease, the sales will decrease as well. Okay, when the sales will decrease, the EBIT will decrease as well. So here it is 40% increase. So if the 40% increase, which means it's a good thing, right? But when the sales will decrease by only 10%, it's here increased by 10%. But here if it is decreased by 10%, then this will EBIT will decrease by 40% as well. So in case of increasing profit, you will enjoy the EBIT profit. But in case of decreasing the sales, this will be painful for your business, because you have the fixed obligations for the cost. Okay, so which means that you have the high variability, which means you have the very high EBIT variability, high EBIT variability, high EBIT variability. So this is a risk, and this risk is called the business risk. Is we face the risk due to the due to our finances, because we face this risk due to our finance method, because we used the debt, in the capital structure. So fixed that is a fixed cost. So that is a fixed cost, because we have to pay the debt holders the fixed interest rates. Even if we don't have the profit, we have to pay the debt holders the interest. So it is a fixed cost, and that's why we will face the financial gearing. Gearing means obligation. So we face the financial obligation, and here we have the operating obligations. Okay, so so note that preference shares are also treated as debt for the gearing calculation. Okay, so the redeemable preference shares is equal to gearing. Why? Because the redeemable preference shares get the dividend plus at the end they will get the redemption of capital as well. So which means that they have the characteristics of a debt finance. So it is equal to debt, or I can say that it is a gearing. So it is treated as debt for gearing calculation. Okay, the greater the financial gearing, the greater the EBIT variability and lead to financial risk. Means if you have the high financial gearing, high financial gearing or high interest, when you have the high interest obligation, which means your profit will decrease. Your earning before tax will decrease and lead to increase in financial risk, and vice versa, okay, and vice versa, okay. So the formula for this to calculate is debt divided by equity, and you know that debt long term debt plus the preference share. Here we are considering the preference share as a debt. Okay, so ordinary share capital plus the reserves, that is the part of the capital, you know, that reserves. Okay, so long term debt plus preference share and the long term capital, it means that debt plus equity. Here you have the debt only, okay, here you have the debt, here you have the equity only, okay. So also you can calculate gearing using this formula. Here you have the interest and here you have the PB, profit before interest and tax. This formula is also known as interest cover. How much? How many times? How many times? Many times your before interest tax cover interest. Okay. So for comparison purpose, the same ratio must be used consistently. Okay. So let's understand this question. Calculate the impact on the firm C of a 10% fall in share sales and comment on your results. Okay. So the 10% fall in sales. You have the sales, variable cost, fixed cost, and operating profit, and the interest and profit before tax. So you have the sales, that is 10 to 53, and that's the same numbers there. And you have to decrease the sales by 10%, 10% decrease. So it's 9. You have the variable cost that must be decreased by 10% as well. It is 1.8, and you have the fixed that will remain the fixed. Okay, and so you have the operating profit as 2.2, and here the interest is 2, that is fixed, interest for the debt holders. So 2, you have the profit before tax here 1, but here only 2.1. The impact of 10% decrease in sales reduce the operating earning by 26%. Operating earning, this is the operating earning. But we will understand this profit before tax, how much profit before tax reduced. So when you consider this, the reduction in profit before tax is how much? 80% reduced. But here only the sales reduced by 10%. The sales reduced by 10%, but the profit before tax reduced by 80%. So you can see how variable the profit before tax due to sales. So however she has debt interest obligations. The financial gearing has effect of amplifying the variability, which means you are already have the fixed cost. You have the fixed cost, which means it is already reduced this by 26%. We understand this. This is the operating gearing. Operating gearing. This is the financial gearing. Okay, so financial gearing effect here is 26%, it reduced. But when you see that it is 80% decrease here due to the financial gearing risk. Okay, due to financial gearing risk, our profit has further reduced by 80%. So this is the 80%. So you have the additional 53% variation over and above the cause of operating earning due to debt finance. So debt finance is another risky area where you have to consider the where you have to bear in mind that it make your profit look good or look poor depending on the circumstances. If you have the stable business, then you can use this as an advantage to increase the profit. But if you are expecting that your future of the business will not be as profitable as it seems, so you don't have to use the fixed cost. Here the fixed cost, try to reduce the fixed cost as well as try to reduce the debt from your business and increase the increase the equity finance in your business. But you have to consider in mind that in order to reduce the in order to reduce the WACC, weighted average cost of capital, you have to use the interest debt finance. So when you use the interest debt finance, when you use the debt finance, it gives you advantage of reducing the WACC, because debt has the advantage of tax advantage. So we will understand this in the later. Okay, so let's understand here the market value of a company. So market value of a company depends on the WACC. If you have the lower WACC, your market value will increase. But if you have the higher WACC, your market value will decrease. Your company market value will decrease, because the cash flow is the because the company value equal, or I can say the market value of a company is is present value of its future cash flow. So in order to calculate this future if in order to convert this future cash flow into present value, we have to use the discount factor, or this cost of capital cost of capital and discount these cash flow at the cost of capital rate. Okay, so here it's WACC. We have to use the WACC as a discount factor. So you have the future cash flow. We are dividing this by the by the WACC, because we are assuming that we will get the cash flow in perpetuity, means infinite. If you are getting 100, which means you are getting this $100 infinite every year. Okay, that's why we are dividing it by WACC. Otherwise we will cash flow multiplied by discount factor, that is your WACC. Okay, we will multiply and then you will get the present value, but here we are dividing it. Okay, so the market value of a company is, here it's 667 and here it's 1000. So when you reduce the WACC, your market value will increase. But here you have increased the WACC, so your market value reduced. Your market value only 667 and here it's 1000. So WACC is a weighted average of various sources of finance. So it is a weighted average. It is a weighted average of debt, equity, and other forms of finance. So you have to calculate this by using the weight of the every finance. Okay. That is cheaper. That is cheaper. Why? Because lower risk. Because lower risk. That is cheaper than equity because lower risk. Or finance provider, the the finance provider, the debt holder who provide the finance get fixed interest, fixed interest fixed interest as income. So they don't have the risk. So which means they have the lower risk. So when they have the lower risk, which means they have the lower risk, when they have the lower risk, their expectations, expectation is also lower. Which means when they are expecting lower expectations, which means they are expecting lower interest. So lower interest means lower cost of capital. Okay, so that's why it's cheaper. That is cheaper. And you get the tax relief on the interest, which means that the interest that we pay on the debt is deductible for the tax purpose. So first you deduct your interest from the profit, then you charge tax on that amount. Okay, so you get the tax benefit because you get the profit lower taxable profit. Okay, so that's why you pay lower tax. Okay, so you get the tax advantage, and ultimately it's a saving for your company, and that become cheaper. Okay, but increasing levels of debt is more risky. But when you increase the debt further and further, when you add the debt further and further, which means you create fixed commitment before the equity finance risk. Which means if you further increase the debt, it will create the risk for the equity holders, because they get their dividend after paying the interest to the debt holders. When they get, but when you add the debt finance into the business, you will have to pay more interest, and the profit will be reduced. When the profit reduced, the equity holders will get lower dividend, or most of the time they don't get any dividend. So it's more risky for the equity holders, which means if they are facing the if they don't get the dividend, they will expect expect higher higher return higher return from their capital. When you have the lower debt, they are expecting 10%. But when you further add the debt, they are expecting now 15%. So this is the risk. Okay, so increasing financial gearing increase the cost of equity. I explained this. Okay, and would lead to increase in WACC. So you know that WACC is the weighted average of equity plus debt. So the cost of the equity will increase, which means WACC will increase. Okay. So this is the risk that we face. A company value is the present value of its future cash flow discounted at WACC. Okay, so value of company is equal to present value of future cash flow. That future cash flow must be discounted by WACC rate, WACC rate. Okay, so this is the value of the company. So theories as to how to minimize the WACC. So how can you minimize the WACC? Because when you minimize the WACC, when you reduce the WACC, which means when you reduce the WACC, the future cash flow will increase. When the future cash flow, the present value of future cash flow will be higher, which means the value of company will be higher. So if you reduce the WACC, if you reduce the WACC, your value of company will increase. When you increase the WACC, value of company will reduce. Okay, so it is a inverse relationship. It is a inverse relationship. So here I will draw a chart. Here we have the WACC. Here you have the value of company. Value of company. So this is the inverse relationship, right? So let's, here it's a, so when you increased, so when you reduced the WACC, when you reduce the WACC, the value of company, when you reduced the WACC, the value of company increased. But when you increased the WACC, when you increase the WACC, the value of company reduced. Okay, when you reduce the WACC, the value of company reduced. Okay, so you can understand this uh, by this graph, that it is an inverse relationship between WACC, WACC rate and the value of company. Okay, so how can we minimize the WACC? Now we understand that we have to minimize the WACC, weighted average cost of capital, in order to increase the value of a company, because increasing the value of a company is the ultimate goal of a is the ultimate objective. It is the ultimate objective of a finance manager, okay, the CFO. So in order to minimize the WACC, in order to minimize the WACC, we have these some theories. So what are these theories? The theories are traditional views, M&M, no tax, M&M tax, and pecking order theory. So let's understand this traditional theory. So in this traditional theory, we have just seen that debt is a cheaper source of finance than equity, cheaper source of finance than equity, because it has the tax advantage and the interest rate is fixed. Okay, so interest rate is fixed. When we have the increasing profit, when we have the stable business, this will benefit us. Okay, so the introducing debt, when you introduce debt, it will increase risk to the debt holders. When you increase debt, when you increase debt, this will create the risk for the shareholder. Why? Because the risk for, how this will create risk for the shareholders, because when you increase the debt, it will increase the your interest obligation. So you have to pay this interest every year to the debt holders. Because this interest is paid before the dividend is paid, because this interest is paid before the dividend is paid. So the profit available to equity shareholders will be lower. So they will, this will increase the risk for the shareholders, and they demand higher, they demand higher higher return. So cost of equity will increase. So when the risk increase for the shareholders, they demand higher return. Okay, they demand higher return. So when so having cheaper debt, more expensive equity. So I can say that you have one side the cheaper debt, but on the other side you will have the expensive equity, because equity holders will demand higher return. Okay, the traditional view of capital structure states that introducing debt starts off by being a good thing as WACC falls. When you initially, when you initially start using the debt, when you initially include the debt in the capital structure, the WACC will fall. When you initially, it will fall, but because you increase this the but because you increased debt continuously, this will create the risk. So this risk means this is the risk for shareholders that they don't get the dividend and they demand the higher cost of equity. Okay, so the cost of equity will increase. But what happened? But this increase in cost, this increase in equity, this increase in equity will be lower in case of cheaper debt. Okay, what does it mean? It means that you will ultimately benefit from the debt even if the cost of equity is increasing, because the benefit outweigh the benefit from the from the from this debt from this debt uh, from this debt will outweigh the expense for the expense that we will pay for the equity. Okay, however, as the level of debt increases further, the cost of equity starts rise faster. However, what happened that at the end, when you start to rise again and again, at some point that outweigh that benefit you are getting from the debt, it ultimately outweigh the extra cheap debt and will cost the WACC will also rise. Okay, the WACC will also rise. So let's understand this through an through a graph so that you can easily understand. So this is the graph that the traditional view when you initially start using the debt. So debt is a fixed interest. So when you initially start the debt, the cost of equity will increase. But when you reach at a point like this here, so this point means you are using so much debt. So so when you are using so much debt, the equity holders assume that you could not pay the dividend and you ultimately face the face bankrupt risk. So this is the anticipation, this is the risk that they anticipate, the equity holders, that when you initially the ultimate when you start increasing the debt in your capital structure, then you will face the bankrupt, because you cannot pay the interest, that is fixed obligation, if your profit decrease. Okay, so which means they are facing the higher risk higher risk. So the cost of equity will increase, they demand higher return. Okay, and when you increase the further debt when you increase the further debt when you increase further debt from this point, when you increase debt, this ultimately risk of risk of non-payment of interest to debt holders. So the new debt holders, they will assume that you cannot pay this higher interest if you take more debt. So their cost of debt also increase. Cost of debt also increase. So ultimately, initially you have the cheaper debt which will reduce the WACC. Ultimate point will come that will indicate that your WACC will increase, because your equity and your debt cost will increase substantially at the end. Okay, so this is the cost of WACC. So what is the market value? Market value and WACC. So initially, when your WACC is reducing, the market value will increase, right? Your market value will increase. But what happens when your WACC increase, your market value will fall. Okay, your market value will fall. So this is a point from where your market value will fall. So it can be seen from the above graph that the traditional view suggests that there is an optimal capital structure where WACC is at the minimum. So this structure, this theory says that there is a optimal point where WACC will be lower. WACC will be lower. Okay. So how can we calculate that optimal level? How can we calculate this? There is no straight formula for this, but you can calculate by slowly increasing the debt, slowly increasing the debt, and then calculate the WACC. Okay, slowly increase the cost of debt and calculate the WACC. You increase the WACC, you calculate the increase the cost of debt, in calculate the WACC. Okay, so there is a point where you will see that the cost of equity, sorry, the WACC is, you will see that WACC is lower here. Okay, so so you will see that WACC is lower. Hence, trial and error method is used to find the optimum point. Okay. After traditional theory, we have next the M&M no tax. Okay, it is given in 1958. So the no tax theory, let's understand this by this graph. So when you increase the debt, the equity will increase, equity cost will increase. Okay, but your WACC remains same, but your WACC remains stable. Why? Because there is no tax, there is no tax benefit. When you don't have the tax benefit, your WACC will be remain same. When you have no tax, which means when you don't have the tax, which means when you don't have the tax benefit, your WACC will remain same. So okay, so M&M initial views that summarize as WACC, as that introduced, the cost of equity rises. As WACC increased, the equity will increase, because when you increase the debt, the risk for the equity holders is that they get the profit available for profit available to equity shareholders will reduce when you increase the debt, because interest for the debt is paid before the dividend is paid. So the profit will reduce, so their risk will increase. When the risk increase, they want higher return, which means higher cost of equity. Okay, without any tax saving on interest payment, benefit of extra cheap debt is only enough to offset the increased cost of equity, because you don't have the tax benefit. So the benefit of this cheap debt, that is the fixed interest, is only offset the increase in risk, that the return that we will provide. So this benefit will only offset the cost to the equity holders. Okay, hence WACC will remain same and unchanged, and no optimal capital structure. Okay, next is when you have the tax, you know that debt will remain same, when you increase this debt, but equity will rise, but WACC will reduce. Why reduce? Because you have the tax benefit. Because of tax benefit, the WACC will reduce. So WACC reduce, when WACC reduce, the market value will increase. Market value will increase. Okay. So when WACC reduced, the market value will increase. Okay. This is the market value. But when the WACC remains same, when WACC remains same, the market value will also remain same, right? Okay, let's understand this part using the numericals, that if the company use interest, if the company has interest obligation, which means it is using the debt, if the another company is, if this company is no debt, no debt, which means no gearing, no gearing, means it has debt, debt and gearing. So if the company don't have the debt and they have the same, they have the same earning, okay, when they have the same earning, this company don't pay the interest, no interest obligation, but this will pay the interest. And because we are assuming that there is no tax, so the after tax earning will be 1800, 600, 400, for the 700, 1500 and 300. For the debt holders return is nil here, but here it is 100, 100, 100 that we paid the interest. For equity holders, this is the full amount that they will get, but for equity holders, they will get the after the deduction, they will get 700, 700, sorry, 100, 100, 100, and here they will get 800 minus 100, 700, 1500 minus 1500 minus 100, 1500 and 1400 minus, this will get 300. Okay, so the total return for the investors 800, 600, 400, but here it is combined 800, 600, 400, because there is no taxation. So so the return for the total investors is same, right? The return is same here. But when we consider the tax, the return will be, the return will be reduced for the total investors. Okay, here it is 560, 1120, 180. Here it is uh, it is, and when we consider the tax, the interest will be deductible before the tax. So the benefit of tax benefit, because we get the tax benefit, because of tax benefit, we have, the investors have the higher return. So investors have higher return due to tax benefit. So investors, there is no debt holders, so this amount fully given to equity holders. So here we distributed 100, 100, 100, but for equity this is for 90, 105 and 210. But when we consider this total how much we paid, total we paid higher to the total investors because of this tax benefit. And this tax benefit is 30 here, because we are paying the 240 interest if the company don't have the debt, If the company have the debt, then we pay only 30 as a tax, and sorry, 210, and save 30 tax, saving 30 tax, and saving here 30 as well. So this saving we distributed to the investors. So this benefit is given to the investors. So let's understand the assumptions that is taken when formulating this theory. So there are some assumptions that capital market are perfect, which means the share market is perfect, means that investors have same information as the as the as the as the owners, and their price reflect this. Okay, so investor have same information, and if they have the same information, the share price will reflect the future uh, benefits and any losses. Which means if the benefit, then the share price will be adjusted accordingly. Okay, the investors are rational, which means knowledgeable. They are knowledgeable and risk averse, means they don't take high risk. No risk taking ability. Okay, there is no transaction cost. You can buy and sell without without fees. That is generally charged by the brokers. When you buy and sell through the brokers, they charge a transaction fees, but here we assume that there is no transaction cost, and that is always risk free, which means that you can take as much as that, and there is no risk in that. The Okay, and there is no taxation that we considered here, but in the next we consider there is a taxation. Okay. Capital market imperfections and their impact on M&M. In real world, capital markets are not perfect. I already told you that capital market are not perfect because not same information and suffer imperfections, and which means they are not perfect. So companies cannot always raise finance when required. So companies cannot always raise finance, so there is a risk of bankrupt. So whenever they need money, finance, they cannot raise, and the bankrupt, they will face the bankrupt's risk, because if they increase the debt, so this risk increases as the level of gearing increases, so deters companies from having high debt. Okay, debt is not always risk free. Especially at high gearing. So the cost of debt will increase when you have high gearing. When you have the high gearing, so cost of debt will increase, because the debt holders, the new debt holders from you are going to take the money, the finance, they expect, they will analyze that you have lots of debt in your, you are already taken lots of finance from the debt holders. So how can you pay when you don't have the income in future? So there is a risk that you cannot pay the fixed interest on the debt, and this means that they will charge higher 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 return, which means they are expecting higher return. So increase in gearing, increase in gearing, increase in risk, increase in gearing, increase in risk for the debt holders. So they want higher return. Okay, they want higher return. So increase that. So WACC will stop falling and start rising. So WACC will not fall, instead WACC will increase, right? The tax saving on interest payment only exists while the company has sufficient pre-interest profit. So tax saving only available when you don't have the profit. When you don't have the profit, in case of profit, if you have the profit, then you pay this interest, and that is 90, and then you pay tax 30% on this, and you save the tax because you are not paying at 100, you are paying at 90. But when you don't have the income, when you don't have the income, for example, if you have only 5 as a $5 as a profit, so interest is 10, and you have minus 5, but you when you charge tax on this, which means you are not getting the tax benefit, you are not getting the tax benefit. So when you don't get the tax benefit, which means it is exhausted. Tax saving on interest payment only exists when the company has sufficient pre-interest profit. Once the interest payment is exceed the pre-interest profit known as tax exhaustion, no longer any benefit from increasing the level of debt finance. Okay, so these are the limitations, because that's why you cannot always take debt. So because you face bankrupt risk, because this gearing will increase the cost of debt, and because of tax exhaustion, the debt will not be cheaper for your company. So you cannot always raise debt because of these regions. So the assumption that is used in the M&M theory, that you can raise that as much as possible, that is not the case, and it is not the realistic assumption. Okay, so next is the pecking order theory, another last theory we have to understand. In the pecking order theory, it says that firm select finance in this order. Firm select finance in a order that is cheap and lower cost of issuance. Moving down the list, there is a insufficient finance at earlier level. If you don't have the available finance at this level, if you require $1,000, but when you have the 50 here, then you move to the next and take 100 here. If you don't have, still you don't have the 1,000, then you can move here and take for example 850 from here. Okay, so if the 1,000 is available here, then you can use whole retained earning from this. Okay, so in which order you have to use? First you take the retained earning, because retained earning is the easiest, quickest and cheapest method, because this is the retained earning, means this is the retained profit. So there is no need to raise, no need to pay any interest or dividend on this, and there is no issue cost. So this is the best way to get finance. Okay, next is the debt, because it is because you get the uh, tax benefit, because you get the tax benefit. So when you get the tax benefit, this is a cheaper source of finance. and cheaper of source of finance, which means you should use this when you have the profit available. And it is also a sign of management confidence, because you are paying the fixed interest. So the investors think that, because they are because it means that that the company has the good future, so that they are able to pay the fixed interest on the debt. Okay, that's why they are taking the debt so much. Next is the convertible debt. This offers investors the potential to benefit at the expense of shareholders if company does well. Convertible debt means you can convert, issue, issued as debt, issued as debt, issued as debt, issued as debt, but convert into equity. Means when you issue this as debt, and you are giving this benefit of conversion. So if you are giving this benefit of conversion, so the cost of convertible debt will be lower than equity because of this benefit. So that's why you should use this convertible debt. Next is the preference shares, because they are getting the preference, dividend, preference of payment of dividend, because they are getting the preference of payment of dividend, and the repayment of capital. So they are expect lower dividend than equity. So this is the cheaper source of finance than the equity, that is the ordinary shareholders. It is time consuming, because you have to raise the prospectus when you issue the equity shares, ordinary shares. You have to issue the prospectus, and the underwriting. You have to pay underwriting commission. If underwriting commission to the investment banker, you pay underwriting commission, because if your shares are not fully subscribed, then the underwriter will subscribe and give you the finance. Okay, so you issue prospect, underwriting commission you pay, and which means this is a expensive source of finance, expensive to service, and if unsuccessful leads to general loss of confidence and actually fall in share price. So this is very expensive source of finance. And also the equity shareholders expect that the dividend they are expecting should be higher percentage and they are the owners. So they are expecting something, I mean they are taking the higher risk, so they are expecting highest return from their investment. Okay, so this is the expensive source of finance. When we should use WACC, so you have to use WACC when you investment appraisal, when you decide to invest in a project, and when you calculate the value of a company. Okay, so the WACC reflects the company existing business risk and financial risk. Okay, so hence WACC includes business risk and financial risk. The business risk is this, is the interest, and the business risk is the fixed cost, and financial risk is the interest, which is debt, right? Hence, we use WACC, current WACC, to appraise new project. So you can use your company WACC as long as the new project is and or have when the new project have same business risk as our existing operations, and for example your existing business nature and your new business nature. Existing business nature is bakery, and the new business in which you are going to invest is also bakery. Business risk will be same. Okay, so there is no change in capital structure. So capital structure, when there is no change in capital structure, means debt divide equity. If you have 50-50 ratio here, if you have 50-50 ratio in the new company capital structure also 50-50, which means their financial risk also same, your financial risk also same. Okay, when you have the same financial risk, same business risk, and your the and if you are investing in a project that is relatively small, then you can use your existing WACC, because it is not material, because the calculating the WACC does not make any difference, because the new project is not material. Okay, so we are not using project specific finance, that is government grant, that is tied to us specific. So if you are using the debt and equity here, so you are using debt and equity here. So here there is no other finance like donation or grant. Okay, you have debt here, equity here, you debt here, equity here. So you have the same business risk, same financial risk. So you can use your existing company WACC to the new company in which you are investing, to calculate the investment whether it is beneficial or not. Okay, so let's understand the risk. So this financial risk and business risk, this risk can be measured using beta. This is beta, right? So a risk can be measured by beta. So beta means a measuring unit of risk. So like you measure the water in liter, and fruits in kg liter. So that's the same way you measure risk in beta. Okay, so ungeared company all equity, if you asset beta, and there are two types of beta, that is asset beta and equity beta. Okay, so asset beta means this is asset beta, this is equity beta. Asset beta means ungeared company. Ungeared means no debt. Geared means debt. Geared means debt. So if you don't have the debt, means you have only fixed cost, and fixed cost means you have the business risk only. You only have the business risk percent. Okay, when you have the debt, which means you have the interest, and when you have the interest, which means you have the financial risk percent. When you have the financial risk percent, which also means that you have the fixed cost as well, so you have the business risk as well. Okay, in which in this you have the both risk, but in this you only have the business risk. Okay, let's so now we learn that if we have the same business risk and financial risk, if we have the same business risk and financial risk, then we can use the same WACC. Okay, but what if this new company in which we are investing is not bakery, it is like something manufacturing of electronics. Okay, if it is manufacturing of electronics, this business will face different business risk than this our bakery business. So their business risk, the new business risk, will be different. And if for example this ratio is not 50, this ratio is 70, this ratio is 70 and 30, which means that capital structure is also different. So the financial risk is also different for the new company in which we are going to invest. So now we have to adjust. So our business risk and financial risk is different. So now we have to adjust this through in our WACC. So we have to calculate the revised WACC. So we cannot use the existing WACC. Instead, we have to calculate the revised, adjusted, risk adjusted, revised risk adjusted WACC. Okay. How we will calculate this? We will calculate this using the CAPM, which is used in our cost of equity formula. Okay, so a change in capital structure, if the long-term gearing of the company changes, then the cost of equity will increase. So it says that because of change in gearing, because here it is 70, then which means that increase in debt, and you know that when the debt increase, the equity shareholders risk increase, because they don't, because profit available to equity shareholders reduced. So profit share available to equity shareholders reduced, so their risk will increase. They don't get the dividend, so they are expecting higher return. Higher return means increase in cost of equity. So increase in cost of equity, so we have to calculate the revised cost of equity. We have to calculate the revised cost of equity. So this cost of equity revised we will use in the WACC. Okay, so how we will calculate the revised equity? For this revised equity, we will use CAPM formula. Okay, CAPM formula. This is the CAPM for the cost of equity. So in this formula, we have this beta. This is the beta. That is a measuring unit of risk. Okay, and this beta is beta equity. This beta is beta equity. All this you don't need to understand and remember. Okay, so you know that beta asset is the asset beta. Asset beta is the ungeared beta, and beta equity is geared beta. Okay, and this debt beta is we don't consider, because debt is risk free. If debt is risk free, so we can assume this as zero. Okay, when debt is risk free, we can assume this beta as 0, So we don't need to consider this in the formula. So which formula we have to learn? This beta set formula you have to learn. Okay, then we follow the steps. What are the steps? Then you ungear the company equity beta, ungear, then ungear, regear, calculate the new beta equity, that is regear. Okay, ungear, regear of the existing company, existing company information. You use existing company value of equity, existing company value of equity, existing company value of debt. Okay, and this existing company value of beta equity. And here you will use new company information, the new company value of equity, new company value of debt, new company value of equity and beta asset. Okay, then this beta equity will be for the new company, so we can use this new company equity beta in the formula. Okay, then we will calculate the cost of equity. First, you have to ungear using the existing company information, regear to new company information, then you calculate cost of equity using this formula, and you will calculate the WACC, and that WACC you can use in the project appraisal. So these are the 4 steps: 1, 2, 3, 4, and at the end 5. These are the only 5 steps, or mostly these are the only 4 steps: ungear, regear, cost of equity, and WACC. Okay, now a change in business risk. If company invests in a new project in the business sector, is exposed to new risk. Okay, hence the both cost of equity and WACC needs to be calculated. Okay, these are the steps you have to follow. These steps given, so we don't need to consider regear. Okay, you don't need to learn this. Okay, B company, and we have to calculate the suitable cost of equity for the company, for the project. Okay, cost of equity. So B company is a hot air balloon manufacturer whose equity to debt ratio, debt to equity ratio, this, and the corporate debt, which is assumed to be risk free, which means beta debt is 0. So we can use this formula, which means you can use this formula, and we have to only remember this formula. Okay, only. And okay, so this is the gross redemption yield. No need to remember this. The beta value of the company is, this is the beta equity, the average return on the stock market is 16%. Okay, this is the existing WACC. Okay, no need to remember this. Tax is the company is considering water bed manufacturing project, which means new different business than ours. So the business risk will be different. So business risk will be different. We are hot air balloon manufacturer, and this is water bed manufacturing. So we have different business, so business risk will be different. And now we have to calculate the revised risk adjusted WACC. We have to calculate the revised WACC to analyze whether this new project is beneficial or not. Okay, so revised WACC we have to calculate. So this is the beta equity and debt to equity of the new. So let's calculate. First step is find an appropriate asset beta. B company has selected the appropriate equity beta for the water bed manufacturing, that is 1.59, but in order to perform the calculation this needs to be de-geared into asset beta. And so now we have to de-gear asset beta and find the business risk of the new project. Okay, so how can we calculate? And you know that asset beta only have the business risk. So business risk, asset beta only have the business risk. So let's calculate this 1.59 and this is the 2 and this one is the 1. Okay, from here you have to calculate the business risk of the new company is 1.8. I want to make a correction that this is the new company information that we have to use, and here we have to use the existing company information. Sorry about this. Okay, so this we have calculated using the new company information. We used this is the debt, okay, this is the debt ratio, this is the required, and equity. So this is the equity, first and debt later. Okay, so we have this is the equity. We have the equity here, value of equity. We have the value of equity here. This is the debt. So we have to consider this debt value after tax. So 1 minus t, this is the tax rate. So we get the asset beta 1.18. Okay, now we have to re-gear this and incorporate our company financial risk. Okay, so now the asset beta is this, and our company 5 equity, that is equity to debt, equity to debt, that is 2, equity is 5. So we have to write 5 is the equity, and we get the equity beta 1.58, and now we can calculate using the beta equity, and this risk-free return is given here. It's given because risk-free, because it is the KD, it is the cost of debt, it is the cost, that is return that we are providing. Okay, so this is the risk-free 11% plus the beta equity, that is 1.15, and the return for the equity average return, this average return is RM, that is 16, and here it's, so you can calculate the cost of equity as 18.55. Okay, so in the next video we will do some questions on this chapter, the sources of finance and this capital structure.
Hey everybody, my name is Neeraj Sen. Thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.